All right, so prime rate drops. Tiff Macklin drops prime rate 0.5%. Well, that's good news for variable rate holders. People who've had variable and gone through hell, they got a much better deal coming because there's going to be more cuts. There should be consistent cuts till we get down to about 2.5 as Tiff Macklin's neutral rate, because it would normally be about 3, but the economy is so crappy that probably it's more like 2.5. But wait, what's going on with fixed rates? What is going on with fixed rates, particularly 5-year fixed? Because 5-year fixed is protection. 5-year fixed is, okay, if it gets down far enough, I'd like to protect myself. I could take variable and then find the right spot on 5-year fixed, 379, 389, 369, and then I can lock in, and that will make me feel great because I've got a good rate. Because let's face it, the days of 2.49 rates, they're probably gone. Or put it to you this way, if they come back, there's a lot of fucking problems going on in the world, okay? Like, if rates go to 0 again, sweet Christ and a cracker, that's going to be a sign of something bad is happening. Not saying it can't happen, but why not? Why not? Would anybody who took a 3.89 fixed rate when interest rates went to 6.29, would those 6.29 people would really have loved the 389? So that's the plan. But why aren't they coming down? Like, Ron, I get this question constantly. Ron, what's with the fixed rates? Why aren't the fixed rates coming down? All right. Talked about it before, cover it again. Fixed rates have got nothing to do with the Bank of Canada. There's some relationship because obviously the bank prime rate, central bank prime rate, whether it's here or any other country, U.S. Treasuries, U.S. Federal Reserve, the central bank in Europe, Bank of Japan, you name it. These are the institutions that create very short-term rates, whether it's a 1 year, whether it's something called repo, which is like overnight rates. These central bank rates create very, very short-term rates that all kinds of financial institutions use. So what about longer rates? What about the 5-year? Okay, 5-year is a function of Canada 5-year bond yields. Now, where do bond yields come from? I won't drive you crazy and turn you into a junior economist, but I will say this. They are a traded commodity. There's billions of bonds traded in a year, billions of Canada 5s and Canada 10s and Canada 2s traded in a year, traded by bond traders, professionals with banks and huge investment institutions, pensions. So these are the people who trade these bonds, who effectively price the bonds. The price generates the yield. So what's it all mean? Why haven't those yields come down? It's this simple. There's 3 main problems. And a lot of it stems from the U.S. Let's face it, the U.S. is the biggest economy on earth. It's the reserve currency. It's where everyone looks. Don't give me the BRIC stuff. Don't give me the China stuff. Don't give me all that stuff. Today, the U.S. economy rules the roost. Might not be forever, but it is today. So those 10-year bonds, which is their biggest trade, they have actually gone up a bit. They have not come down. It's very unexpected. People thought they'd be down by now. The Jerome Powell at Federal Reserve announced cuts, and they said, well, I'm going to keep cutting. So what's going on? Well, in the States, they call them bond vigilantes. There are people in the States who would say, okay, you know what? I think the future's bad, because, that's what it's all about. When you're pricing out a 10-year bond, you're trying to figure out from today to a point in the future, and how am I going to play it? That's really the truth. It's a bet. These people are taking on a certain amount of risk. It's highly, highly, highly analyzed. It's risk proof. There's tons of things go into the thought about this. But there are problems that could lurk out there that would affect the immediate future, like a year from now, 2 years from now. So what about war? War in the Middle East, bombing oil fields, going to create inflation again. Deficits, massive deficits in the United States. Printing money in the United States continues to create some inflation for the U.S. Finally, what if there actually is just a sovereign debt crisis? That means some country gets into unmanageable trouble with their own bonds. And how will that spread out, and what fire will that catch the rest of the bond market? That's just a few of the things. There's actually more, but here's the key point. Canada is kind of dragged along by these bond vigilantes in the U.S. They're just such a massive part of universal trading in the world in bonds that this gets pulled along. So what should we think? Are they just going to keep going up, Ron? I mean, what are we? Is the 5-year going to keep going up? Is the variable going to keep going down? Eventually, the 5-year will come off some. But let's get very, very clear on this. If the best possible outcome for a variable rate mortgage is it drops all the way down to a range of, say, 3.3 to 3.65 or 3.2 to 3.7, somewhere in that range, because CMHC is obviously, you can get a CMHC mortgage, you can get a bigger discount, the government-backed mortgage. So where will fixed rates be? Well, typically, they'll be somewhere between 3.69 and maybe a little bit of 3.59 with the CMHC mortgage, and maybe 3.94, 3.89. So that's all there really is. And, we've got lots of rates out there. We got a 3.99 rate out there today on a 5-year fixed. It's only one lender, and it's only CMHC in purchases, but it's out there. So what I'm here to tell you is, yes, variable will fall. It will continue to fall. The Bank of Canada will keep cutting prime, and fixed rates will eventually come down. But the chance of seeing a fixed rate below 3%, unless there is an enormous crisis on Earth, is incredibly unlikely. The rate will be somewhere on the CMHC side in the less than 3.5, and on the conventional side, more than 3.5. So reality is that there won't be any kind of massive down into the 2.49, 5-year fixed, not happening. Don't wait for it. If that's your plan, stop it. Don't wait. It's not happening. It won't happen unless something unbelievable occurs. And that's what you've got to plan for. Take variable, lock in at 3.89. That's all I got for you today.